If you can design your life where your work is not work, right? It feels like play, and you feel like you can do it forever. Then I think you're probably in a great place.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Brad Johnson. Brad, how are you doing today?
I'm doing great, Todd. Thanks for having me on the show.
Yeah, well, I appreciate you coming on. And Brad is the co-founder and chief investment officer of Vintage Capital. And Brad has over 2 decades of experience across both traditional and alternative asset classes, which is perfect for this show. So he's become one of the go-to voices in mobile home park investing. He's closed over $3.3 billion in commercial real estate deals and blends his hands-on operational experiences with his current role as a capital allocator. So you're also the host of the Alternative Investor podcast. So we'll kind of dive into what that's about and then, dive into what you're doing. So Brad, give our listeners maybe a bit more about your background and we'll get into it.
Yeah, I mean, you nailed it from the 50,000 foot level. It really is an entrepreneurial journey that started with really just a consulting firm that I started in my 20s that focused on the shipping industry randomly, and it was going well, but we were nervous that UPS and FedEx would someday just squash us like a bug. And so we thought, hey, why don't we start taking some of our profits and buy some real estate? And so we started buying single family homes in various markets around the country. And I kind of just took to it. I fell in love with it. It made more sense to me. I thought, well, I can do this forever, investing versus running a consulting business. And so I ended up parting ways and started focusing on commercial real estate more institutionally. So I went and worked for a big private equity firm in San Francisco, cut my chops. Then 2008, 2009 hit, and I realized that we probably weren't going to be buying too many properties in the middle of a financial crisis. So I thought, well, this is probably a good opportunity to brush up on my financial skill set. And I went back and got my MBA at MIT back east, which was a lot of fun. And then took that and parlayed that into a real estate investment banking job, because I thought, what better way to learn all the asset classes than to actually be in the middle of that deal flow? It's kind of like a fire hose of deal activity. I worked on a lot of great big deals, met a ton of people, and that's when I really narrowed in on mobile home parks as a niche for real estate investing, because it had one of the lower default rates for the loans, and yet it had higher cash flow yields than just about anything I was looking at.
Was that still the case today?
It still is the case today. Yeah, I just looked at the TREP numbers for CMBS loan defaults recently, and mobile home parks is like 0.1% default rate currently, whereas multifamily is kind of in the mid single digits right now, because of a fair amount of multifamily apartment guys took on floating rate debt. It wasn't as prevalent with mobile home parks. So that's one of the reasons why there's that discrepancy, but also it's just, the nature of the business. We don't have a lot of new supply coming in to the marketplace. There's not a lot of
almost no new supply.
There's almost no new supply. Effectively, it's declining supply because plenty of these things get redeveloped into larger, higher and better use, mixed use projects, right? Or single family developments.
Yeah. Your competitor is them going somewhere else with a different type of housing, right? That's probably
exactly.
Really
we're kind of the last. Yeah, we're like the last stop on the affordable housing train, right? Yeah. There are communities that look like subdivisions, and that's a little bit different, but the vast majority of mobile home parks are for working class families, and is meant to be an affordable product. And generally speaking, it's like if you're going to leave that property, you're probably buying a home. Something's happened in your life where you've upgraded your net worth and you're going out and buying a home. But the vast majority of people, once they buy a mobile home and they're in the mobile home park, they stay for a very long time.
Yeah. I,
So,
I,
anyways, back to the story. I left the real estate investment bank, started my own company buying mobile home parks over the country with a business partner, and we got up to 2,300 pads. And then we sold that portfolio in 2020 because I couldn't make sense of the underwriting anymore. I couldn't, the math wasn't mathing for me anymore from a cap rate standpoint, from a cash flow standpoint, like it did when I started. Because it's become more popular, quite frankly. It's not quite as easy as it was 12 years ago to buy a mobile home park that generates as much cash as it did then.
yeah.
But still love the space, still have a great network, and decided that I would become more of a co-GP or limited partner, started investing with operators that I knew, because that was a way to really expand my deal flow and expand the amount of deals that I could see and partner and invest in, versus just trying to find that, one perfect deal a year. That's not really enough deal flow, given that it's now more competitive than it was a long time ago.
Yeah, that makes sense. So you went from operator owning it, running the day to day, to
Yeah.
now, hey, we're allocating capital to the best groups out there, getting a little bit more diversity for you and your investors, and potentially even better operations with the right partners.
That's exactly it. Yeah. So I cut my teeth on trying to run these things from 2,000 miles away, and quickly realized that that's not super efficient. So I made plenty of mistakes. I'm a finance guy, an acquisitions guy. I was not the boots on the ground operator. I had to get good at it, and I think I was serviceable, but it was never like my zone of expertise. And thankfully, the pricing was such where you had a huge margin of error that you could make more mistakes than you can today. Today, you better be good at operating these things. You better have a local presence with a real team and real capital to back you up, because it's just not as easy as it once was, because you're having to pay a more market price, a more competitive price, because it's just more popular than it was.
Yeah.
But so I love investing with operators that have kind of planted a flag. They don't have to be located there, but they have to have a cluster of properties. Usually it's like 300 to 500 pads is kind of where you can start to get efficiencies in a market. You can hire somebody that makes a pretty good salary to oversee the 3 or 4 of those parks, and you just want to be able to make sure that you have a team that has, or you're investing with a team that has real infrastructure, right? Layers of management, is using the right technology, has an engineering mindset to operations and property management, as opposed to somebody who fell in love with the thesis of the industry and has a great pitch deck and has a finance background, but actually doesn't know how to evict a tenant, maintain the property, do infrastructure projects, which is really how you drive alpha in this space today. You don't drive alpha from cap rate compression, right? Just getting lucky and the market bailing you out. You drive returns from getting your hands dirty and really driving NOI growth.
Yeah, and that's super important. I want to stay on that for a little bit here, because I think that's really important for my listeners to understand, for all, quite frankly, all asset classes. That's the case all the time. But as you said, I mean, not that long ago, in a lot of asset classes, you could just buy the place, and even if you kind of screwed up a little bit here and there, you still were okay, because cap rates were compressing and everybody wanted to buy. And so you got lucky, right? And that's not the case anymore. I don't know that it's going to be the case anytime soon. Maybe offices, cap rates, you can buy good and it
Yeah.
bounces back, whatever. But I think multifamily and industrial and mobile homes and self-storage and most of these asset classes, you got to learn how to operate them. And they can look good on a spreadsheet, but if you don't know how to pound the pavement, you're not going to be successful. So what do you look for when you're looking for a partner and to bring money to the table? When you're saying, hey, I'm going to bring money to the table, I like this deal. Let's talk boots on the ground. Let's talk asset management, property management. What are some critical things? You've mentioned some already, but what are some critical things that you really want to make sure
Yeah,
that are set.
sure. And we have a full checklist that we go down with our operators, but really, to me, it is getting in the weeds and seeing them light up on their systems, right?
Mm.
Because it you have to every day there's something random that's happening at one of these properties.
Yeah.
They're operationally intensive,
Yeah.
right? So people kind of fall in love with the thesis of, oh, it's a parking lot, the tenant owns the home, I own the land, and it's mailbox money, right? And
Yeah.
that's just
It's
not the case.
easy. Right.
Yeah, it's
Yeah.
not. It's definitely not easy, right? You're dealing with, usually 100 plus families. You're
Mm.
dealing with the city. You're dealing with infrastructure problems, right? That you're really delivering infrastructure
Mm.
to these homes is kind of your main job, right? Is the land, but mostly the infrastructure. And so I need to make sure that these people that we're investing with have layered in the systems and have done a great job on the due diligence for that infrastructure. So we're not surprised with a big capital call on to redo the roads or redo the pipes. And then I need to make sure that they have a team in place that is literally, the invoices or the tenant statements go out in X date, the utility billing. This is how we make sure we're capturing the reimbursement of all the utility billing, which is a huge part of
Yeah.
this asset
For sure.
class, because not every park is direct metered, where the tenant is getting an invoice from the water and and electric company, right? Sometimes you
Yep.
have to bill them directly for their usage, and so you don't have engineering systems in place that are just dialed to chase after those dollars on each unit. Things can get away from you fast, and especially on the rent collection side, right? If you start being lackadaisical with your rent collections and letting tenants pay whenever and are not enforcing the rules and enforcing the rules of just them keeping their lots in good shape, then all of a sudden the whole entire property starts getting away from you because people notice that behavior. They
Mm.
tell their friends, "Oh, you missed a lot payment this month because you have such going on. Don't worry about it. Just pay it in a few months, right? They're not going to do anything." So that can get away from you fast. And it is, if you can imagine this asset class, this tenant base in affordable housing, you can't let somebody go 6 months without paying you,
Yeah.
thinking that they're going to just write a big check one day, right? It gets away from them.
They'll never
This
have
is
that
it's a
money to
great,
catch up.
yeah.
They just,
They generally do not have like $10,000. They're just going to
yeah.
pop into their life to
Yeah.
pay you in one fall swoop. So it's responsible for not only the property, the investors, but it's also responsible for them to have your systems in place to be able to collect efficiently.
Yeah. Good point.
Yeah. So, anyways, it's more of a feeling too when just talking to somebody, because you can't BS me because I was actually an operator, right? I'm going to know pretty quickly, just in having a half hour conversation with somebody, like, have you thought through all the mechanics of this industry? Do you have the right software? Do you have the right personnel in place to actually pull off your business plan? And that's just from just experience. Whereas there are frankly some asset classes that I invest in as a limited partner myself, where I'm not the expert and I'm putting more faith in just the investment thesis as opposed to the general partner that is running that asset. But with mobile home parks, I know it pretty well, so those red flags pop up
Yeah.
in
Yeah. That makes
conversation.
sense.
Yeah.
Um, what are the top beyond? So, I mean, that's part of the due diligence thing, but when we're looking at due diligence for a good investment, when your investors are looking at a deal, or when you have investors and you're like, hey, this is what you should look at to decide if this is the right investment for you, beyond what you just mentioned, where you're digging into the operator, you're making sure the operator can handle it, certainly.
Yeah.
What else do you think is important for investors, those people, LPs that are going to be passive?
Yeah. I mean, this is just a basic one, but people fall in love with the thesis so much that they think they can go to any market and it's still going to work well, right? And it is true that the demand is pretty much unlimited for affordable housing in just about every market that I've looked at, of reasonable size. But the problem is if you go to the middle of nowhere, I don't know, Ohio,
Hmm.
and and there might be the demand for the housing that's through the roof, but they might not be able to afford it, right? So literally you have to have a reasonable economy and incomes at a level that can support a lot rent that is, call it 500 plus with growth opportunities. That's kind of my bar for incomes. So some people use the metric of 100,000 people in the MSA. I don't have any hard and fast rules like that. I just want to see a reasonably large market with some sort of dynamic economy that's not just one industry, of course, right? A lot of people get in trouble with what I would call a man camp,
Yeah.
where there's a booming oil industry or there's a booming data center, construction industry going on, and then demand is through the roof. But of course, that can just disappear in 1 year if that industry has a downturn.
Yeah.
So you want a diverse employment base, and really the population does not need to be growing. It just needs to be stable with incomes growing, right? Because then you can methodically grow lot rent above inflation, not dramatically. I can't stand the operators in the space that try to do 30% every year just because they can, right? I prefer operators that are doing this thoughtfully and sustainably, right? And want to hold these things long term to really take advantage of the tax benefits and the cash flow benefits. This isn't, to me, an IRR 2-3 year type of play. There are randomly those deals that will pop up that are kind of fun as a one-off, but most of the deals that we look at, we would love to hold them 20-30 years
Hmm.
to really
I want
let
to,
those things compound.
yeah, tell me more about that because a lot of,
Yeah.
a lot of groups, syndication groups, especially in the multifamily space and the retail space, it's a 3 to maybe 5 year hold. And that's what they preach, and it's an IRR play. And that's what everybody wants to do. And that's what all these investors, quote unquote, everybody wants. How do you talk to your
Yeah.
investors about this long-term hold? Is there any capital play within it, like a refinance, or what do you, how do you talk to them about that? And obviously people are investing with you, so they're okay with it.
Yeah. Yeah. So we do both funds and syndication. So both like a portfolio of deals and one-off deals. The
Hmm.
vast majority of the one-off deals are still that same profile of like, ideally we'd hold this for 20 plus years. Now, occasionally we find a deal it's hairy and it's a big value add where you got to inject just a ton of capital, right?
Hmm.
So we have one deal in North Carolina that we bought a few years ago with our partner that required 100 homes to be moved in.
Hmm.
These homes are
Wow.
$50,000 plus, so it was a lot of capital, right? So that deal we had to bring in a more institutional partner. So that looks like a traditional 3 to 5 year hold, right? We're probably going to sell that next year for a great outcome. The most of the deals, the reason why we want, besides just wanting to let the cash flow compound and enjoy the tax benefits, the continued tax benefits without having to pay bonus depreciation recapture, right? One of the reasons why we don't want to sell is because it's hard to buy these things. It's hard to
Yeah.
find them. There's not as many apartments or mobile home parks as there are apartments. There's only 50,000 in total in the country, but there's probably only 10,000 that you would want to own, right? Most of them are too small or too rough or in too small of markets that you wouldn't want to invest in those.
Yeah.
So if you only have 10,000 of these things, okay, now what percentage of those are going to sell in any given year? A lot of these owners realize they have a great asset, are getting plenty of cash flow, have depreciated all of their basis down, so they would have a huge tax hit if they sold it. So there's plenty of people that are just not sellers. So when you do get one in a great market that is solid infrastructure that you would like to keep, indefinitely, you're like, why would I sell this thing in 3 years, even if the IRR would be fantastic? Where am I going to put that money? Sure, you can go, buy other asset classes, but if you want to reinvest that money into mobile home parks, well, you might not come across another one, that year. So we certainly like to let the cash flow and tax returns, compound for the long term, as opposed to trying to, just turn these things quickly.
Yeah, I think one of the biggest misunderstandings by a lot of limited partners and even general partners is that you have a lot of taxes that you're going to have to pay. Bonus depreciation, if you took that and cost segregation, you're going to have to pay. You got a big recapture that you have to pay. You have to pay capital gains unless you can 1031 exchange it, which, that might, most of the time, I would say that's probably more of a fantasy than reality. I just
It's
think
hard.
people
Yeah.
discount the fact that they've got all these taxes to repay. And so this, call it 16 IRR that you ended up getting, if you really take your tax consequences into effect, you would have been better off just keeping it.
Yeah, and we occasionally will pull off a 1031, but you're right. You're putting undue pressure to go find another great deal. And as I mentioned, there's not that many of them to begin with. And so you're putting a ton of faith in the operator to then go find that next deal. That deal as good as the one we just sold? Well, that's debatable.
Right.
And then to your point of, well, if you are going to hold this thing for long term, really what we then focus on is the refinance. So our goal is always kind of 5 years, especially right now. Right now is a great time to buy deals with low leverage, right? Do your operational business plan and then go to refinance with Fannie or Freddie. Fannie Mae or Freddie Mac are the two major lenders in our space.
Yeah.
And then pull out your investment. Hopefully it's 100%. Sometimes, it's a little bit less. And then you're really, why would you sell at any given time? If you've taken the money off the table, you're kind of playing with house money is how I look at it.
Yep.
And the property is still cash flowing. Then, why would we sell and take the tax hit?
Right.
Yeah.
Yeah.
But you're absolutely right
agree
on the bonus depreciation. I think it is so compelling and alluring to people, right, to get that tax loss to offset other capital gains. But then if you sell quickly, right, if you sell within a couple of years and you're not in control, right, the GP generally, if you're just a limited partner investing in an apartment building, the GP decides when to sell, right? And they might have gotten a big NOI increase, big rent increase, and that's a huge carrot for them to get into their promote. So if they sell kind of on timing that you weren't expecting, then yeah, you got to pay for that bonus depreciation capture, which is taxed usually at 25% at the federal level, and then you got your state taxes on top of that, and then you got capital gains on the profit. So the tax bill could be pretty substantial. It almost wipes away a lot of the gain that you thought you were going to make.
Yeah. How is the GP getting compensated in a scenario like that? Because a lot of the returns are based on a traditional, I guess, call it traditional. I don't know if there's a such thing as a traditional syndication, but the more common syndication that has been kind of taking place recently is that, there's a pref, then there's a split after the pref, and usually the GP isn't really getting much until a sale happens. Well, if you're going to keep the property long term, how is that GP getting compensated then fairly?
Yeah. So some operators, GPs solve it first of all, they're obviously getting asset management fees. They're getting property management fees that covers their overhead and team. The main goal is, or the main line of defense against that is refinance, right? So once you refinance, you pay back everybody's capital. Well, there goes the pref. The pref is now wiped out, typically, right? The other line of defense on a deal where we want to hold this thing for very, very long term is catch up, right? So the GP can layer in a catch up, which just says, look, as long as we're above the preferred return, when we go to sell this thing in 15 years, right? If we've given you above an 8%, right? Then every single dollar of profit is split 70-30 or 60-40 or 80-20, whatever the waterfall split is with the GP and the LP, right? A catch-up basically just eliminates that pref, because people don't think about this, is that when you're holding something 15 years plus, you don't need a 15 IRR to have a crazy good outcome, right? Any kind of double-digit return is amazing when you're at 15, 20, 30 years. The compounding just really does some miracles after after 15 years. So you want to have that catch up in there. If you're a GP and you want to hold this thing for 20 years, once again, the refinance is goal number one, but the catch up would be defense number two, to make sure it's fair to the GP and the LP, frankly, too.
Yep.
Because you don't want, as the LP, you don't want to disincentivize the GP to sell quickly just to get their profits if this is a great asset.
Yeah, that's always been my contention with the pref, is that if you have just a straight pref and you don't have anything like the catch up like you mentioned, or eliminating the pref at some point in time, well, then it only incentivizes the GP to sell, and the GP has to sell because they don't make any money otherwise. So why would they keep it?
Yeah.
So they're only
exactly right.
Yeah, and you want to be thinking as an LP, like, I want to be in a deal where the GP is making the best decision based on that actual property and the returns that it could make, not just based on what's good for only the GP.
Yeah, Charlie Munger, has drilled this for 100 years, right? Before he passed away. He just, get the incentives right and good things are going to happen, right? And so with the structure that I've just kind of laid out, where there is a catch up in place, that incentivizes the GP to keep letting the deal compound and hold it long term, because there's not that gun to their head with the 8 IRR that you can get behind an 8 IRR. Like if you hold 10 years like that, it starts to really get difficult, and there's just not that much left over if you're holding something for 15, 20 years. Right. So you actually need a catch up to just make it reasonable for both parties.
Yeah. Brad, let's talk about, some of your successes and how you got there. Everybody always wants to know, like, what can they do? How can they repeat somebody else's success? So what are some maybe success habits or tips that you can give our listeners? Maybe 2 or 3, just, good things that you count on and that you feel like have been really key and critical to your success.
Yeah, I think networking with other operators has been very valuable for me. It was when I was an operator myself. I would just go to the industry events, because it's such a weird, small little industry. If here I am in Newport Beach. It's not like I can go down the hall of our office building and find 4 other mobile home park operators, right? I had to go to them. I had to go to the industry events in Las Vegas and Chicago and Miami, right? So I had to make an active, concerted effort to find my colleagues in the industry, learn from them, network them. And you'll find that, I think most people find that people are willing to share their quote secrets, right? Yeah. What has made them successful with their properties. Because if you're coming in good faith and you're earnest about your questions, and they're more than willing to help. And so I would find the stodgy old guy with the bushy eyebrows that had been in the industry for 30 years and just ask, buy him coffee and ask him a million questions about how he did it. Kind of just like what we're doing here with me, right? You want to be able to not make the same mistakes that the guys that blazed the trail before you made, right? Yep. So that was a big one. I think acting before I was ready is another big one. That's a consistent theme in my career, is that you're never truly ready, right? It's like you think you can outstudy something and know every angle of it, but the reality is that we're all just making this up as we go along, and you can make educated guesses, but that's about it. And so I put money to work faster than I felt ready for in the space. But I, had faith in myself that I was going to be able to figure it out once I was in the weeds. Yeah. There is a certain level of diligence, just understanding, like, avoid, these 5 things, right? And if you avoid those 5 things, most of the time you can deal with surprises. Yeah.
You don't have to be haphazard about it.
Yeah, exactly. Don't be ridiculous about it. But, one thing I did do that I do not recommend is I signed a few personal guarantees with lenders to just be able to get deals done, right? Because if you're doing a smaller deal in this space, like the Fannie Mae's kind of want larger deals, 50 unit plus. And so I do not recommend doing that. That's one thing I probably wouldn't jump in with, 2 hands scooping up a bunch of recourse debt, because then that can take you out of the game, right? Early. And to me, the name of the game is continue to play the game as long as you can. Right. Because good things are going to keep happening. Things will compound your skills will compound, your network will compound, your returns then hopefully should as well. But if you take blow up risk, right, and some crazy unlucky thing happens with one property, which I've certainly had have happened before, a flood or a weather event, right? When you own a big enough portfolio, you're guaranteed to have those kind of surprises. Then if you had signed personally, then that could just blow up your life and you're starting over. So you don't want to start over, right? Investors can accept, unlucky things happening, but if you are just like you blow up and then all of a sudden you have to fire the rest of your team and you can't manage your other assets, well, that's irresponsible for not only your own family but your investors as well.
Yeah.
So that's another one is focus on the long term and making sure that you're sufficiently diversified and are not accepting blow up type of risk.
Love it. What's a mistake that you've made, and how can you pass down that wisdom to our listeners?
Underpaying, right, for talent in the beginning was a mistake, because and it's hard. Like I don't blame anybody, it's who's an entrepreneur and is trying to just like scrape it together in the beginning. But really it's kind of short-sighted because you end up bringing on more problems than this person is supposed to be solving. If you're not paying for good talent. And there's ways to mitigate that. I think you end up, when you're starting out, you probably end up spending more time on things that are, quote, below your pay grade. But there's a side benefit to that in that you're learning every little detail about your business that therefore you can then monitor when you're not the person overseeing that aspect of your business. And so I was super grateful in the beginning when we just had a couple of parks that, I was the one talking to the property manager on site. I was the one in our accounting system, making sure things were kind of tying out and then talking to the CPA at the end of the year for tax season. So I could read a K1, right? I still can't, right? So I think in the beginning, people kind of focus on, hey, you got to hire a bunch of people and delegate. And that is 100% true. But I wouldn't rush to do that with people that are bottom of the barrel type of pricing on salaries, because you get what you pay for, right? With talent. So anyways, that's a mistake I made early.
I can second that mistake. I mean, I could think of, the thing that comes to my mind first is just paying like contractors and subcontractors and like going with a guy that's the cheapest bid. It's like, man, it took 3 times longer. I ended up having to fire the guy. I ended up overpaying the guy for what he did because we had to redo a bunch of stuff. And then we hired the next person in to finally finish that job 3 months later. And it costed us, an extra 20% over what we should have paid in the first place.
Yeah. You end up paying for it twice.
Yeah.
Yeah, totally. I made countless of those mistakes early on.
Yeah. Well, and you know what? You keep on making them as you go too. It's just how it is. You're going to continue to make mistakes as long as you're learning from each mistake that you made, and trying to eliminate the big mistakes as you go. I think that's the goal for everybody. But look, I've been in the business a long time. You've been in the business a long time. You still make mistakes and stuff happens.
Yeah.
You got to keep.
Yeah, the goal is not perfection, right? We're never going to hit perfection. We're never going to reach it. Yeah. I think the goal is to reduce our errors, right? So in the beginning, I think I hired at like a 33% success rate, right? And now I think I'm closer to 66%, right? You never really be 100%, right?
Yeah.
Because you honestly, you don't know until somebody's like in month 6 of an employment contract of, are they the right fit? Are they, a hard worker? Is this a good hire, right? You don't really know. So we just try to increase, like slowly, just keep increasing our odds on everything that we do.
Yep. That's a good point. We're going to shift kind of the last couple questions. So what's a favorite book that you could recommend to our listeners?
Oh, I touched on, Charlie Munger here, earlier, but his book, Poor Charlie's Almanac, is, I think, one of the greatest books ever written, especially from not just an investment standpoint, but also from how to live your life standpoint. As a man, as an investor, I think it's extremely useful. He was stoic. He was extremely wise. and you'll get nuggets of investing, but that will also give you a window into, how to live a good life. And
That's
I
funny.
try to reread it every year.
I've done over 800 of these episodes, and that's the first time somebody's mentioned that book to me. I'm really
Oh,
surprised.
really?
I'm really surprised that that's the first time somebody's mentioned that book
Yeah,
to me. So I appreciate the you
it's a
bringing a
great
new
one.
book to the show for our listeners. Last question: what are your three pillars of wealth creation?
Well, sorry to be redundant here because we touched on a lot of these things, but so compounding, letting things really run, because people consistently underestimate the power of compounding. People think linearly in a linear fashion, and exponential growth is really hard for humans to grasp, right? And so model things out to just see the benefit of that math, and then apply that to everything that you can in life. Uh, is a big believer, or is big proponent component of my wealth approach. And then focusing on after tax returns, not just gross returns, is another one. It doesn't really matter what return is; it matters what your after tax
Yeah.
wealth is, right? So that's a huge one too. And so you don't want to just always do investments that are tax inefficient, right? If you had an entire portfolio of just debt income that's taxed at ordinary income, you got to cut the return in half mentally. So you want to have a diverse portfolio of investments, some of which have some tax benefits like real estate. And then the last one is also diversification, right? You do get wealthy focusing in putting most of your effort into one channel. But once you start gaining some real wealth and start having some bigger checks come your way, then I would make sure to quickly diversify into multiple asset classes, because nobody truly knows what's going to happen. We can't predict the future. Nobody knows what interest rates are going to do. And so because we can't forecast with any real precision what's going to happen in any asset class, you want to have several of them. So those are my three.
Yeah, and along with diversification, like I get focusing on one thing, but I think to me, focusing on one thing is really good for how you make your money. Focusing on
Yes.
Diversification is the way to invest your money. So to me, those
Yes.
are two different things, right?
You're spot on.
Yeah, so I love that. Brad, anything else? Any other words of wisdom? Anything else that we maybe didn't hit on that you want to pass to our listeners?
Honestly, no. I think that was a fun conversation. I love what I do, and maybe that's what I'll pass on, is that because I kind of focus on long term concepts here in this conversation. One of the main things that I was trying to accomplish with this phase of my career is trying to do something that I could do forever, right? Because you might not need the money at 65, 70, right? But if you're just on a beach or golfing, right, you're going to lose a lot of the great part about life, and you're probably going to lose a little bit of your sharpness.
Yeah.
And so my grandpa and my wife's grandfather, they both lived to 95, and they were extremely active and mentally acute well into their 90s. And I think that's because they didn't just sit on the couch and watch Jeopardy, right? It's like they were still in the mix. They still were checking on their investments and their business. And so I'm a huge believer in that. And if you can design your life where your work is not work, right? It feels like play, and you feel like you can do it forever, then I think you're probably in a great place.
Brad, beyond this business, what's one thing that you really enjoy doing that helps with your longevity and getting to 95 and still being active?
Yeah, well, I think I need to be better at that. But I think walking and not taking the golf cart every time is good. Thankfully, I have a dog that needs walking every day, so we do that. And a little bit of working out, like lift heavy things, I think is critical. I think you don't want to see your muscles deteriorate. So I try to focus on that. I'm not the greatest at it, but I'm getting better.
Yeah, good stuff. Good stuff. All right, Brad, last question. How can our listeners get in touch with you, learn more about what you got going on, and connect?
Yeah. So you want to learn more about mobile home park investing, you can look at vintage-funds.com. We got a ton of resources there. I'm a big believer in the growth mindset of like, just share as much as we can. There's no secrets. And if that, leads you to invest with us, great. If it leads you to go buy your own mobile home park, and that's even better, because you'll hopefully do it in a sustainable way. And the country desperately needs more affordable housing run the right way. So yeah, vintage-funds.com.
Awesome. Brad, really appreciate it. Appreciate the time. A lot of good stuff here. So listeners, hopefully you took some notes. If you didn't, go back, listen again, take some notes. A lot of great stuff. Brad, appreciate you, and you have a fantastic rest of the day.
Yeah. Thanks for having me on, Todd. It was great.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience, and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.